Okay, so we would assume expected reinvestment rate to be the same as historical average of 0.858 from year 1 to year 10 all the way down, even though the what's that, um, the growth rate will be different. Okay, um, now stable stage growth rate after year 10, so since year 11 all the way down. Okay, how about the stable stage? You would have to compute something called the terminal value. You must have learned it in financial management before. So that's this. Here in our case, it will be big T will be 10. So this guy will be year 11. So you first have to calculate FCFF 11 and then assume it to be growing at stable rate of G. Okay, G of EBIT. Okay, because this is about operating cash flow, so we are using it. And then the simply WACC minus G will be there. One stage growth model at the end of year 10. At the end of year 10, so one tricky part is people always get confused about this. At the end of year 10, so this should be treated as one cash flow at the end of year 10. Okay, you're gonna see it. And then this one is a cash flow at year end, year 11. One more year, one more step. Okay, so that's terminal value, and this takes up a huge portion of your valuation actually. So you have to be very careful about this, right? You need to first determine EBIT, okay, because you cannot expect this to be greater than WACC. I told you before. And then, of course, mathematically you cannot, this guy cannot be bigger than WACC, but if it is negative, is it okay? Which means you anticipate the EBIT to be growing down. It's okay, because minus will be plus. No problem. Okay? Assuming negative growth means that you are just, how do you say? Liquidating your business. Okay? And shrinking down your business overall. Okay? But here we will assume small positive number instead. Okay? Now, terminal value at stable stage, either the product market would be saturated or the market would be crowded by competitors. So the competitive advantage of your company would pretty much disappear, right? Your strategy class, right? You must have learned about the competitive advantage. How does it get linked to finance or accounting, right? Your profit margin or ROC or this kind of efficiency measure, right? Competitive advantage means you can charge higher price for your product than your competitors. If you look at the DuPont analysis and if you focus on the net margin or profit margin sense. For iPhone and Galaxy, it is clear, right? High price, low price in Galaxy. Because iPhone has competitive advantage, they have brand equity, okay? Some people, they are maniacs going for Apple, okay? Galaxy, do they have this kind of fans? Not really. That's a hard part, okay? The brand equity matters. Higher profit margin, recall DuPont analysis, and then it gives you higher cash flow later on. ROC will be bigger. Of course, some of them maybe try to achieve it through better turnover. Maybe the company has a better skill of, using the same asset time and time again. Okay, rolling over and then turning over time and time again. Okay, that may be another way of achieving competitive advantage. But at the stable stage, all these kind of things will disappear. Okay, so much so that in the high growth stage, your ROC and WACC, if you compare, ROC will be bigger than WACC, ROE will be bigger than the cost of equity in young high growth stage. Okay. The management will deliver higher return than what investors require in the capital market. These are what the investors require, required rate of return, right? And these are what management is delivering, okay, to the investors. Return is required. Young stage or fast growth stage, this one will be much bigger than that, okay? But in the stable stage, what will happen? All these things will be eroded, the advantages. As long as the company can sustain its competitive advantage in the product market, they can keep on having higher ROC thanks to high profit margin. How long would the fast growth stage last is a question. It really depends on how long the company could keep its competitive advantage. Significant part of this advantage comes from brand equity, and then the management skills of turnover, high turnover kind of things. And then the company's growth will slow down as their profit margin decreases. Okay, ROC will converge to WACC, and ROE will converge to cost of equity. The management will almost stop delivering higher return than what investors require in the capital market. Now, stable stage, right? So here, you need to first set up, okay, the EBIT growth rate. Okay, stable stage. Here's one tricky part. Okay, the order is different. In the fast growth stage, you computed the growth rate as a multiplication of ROC and reinvestment rate. Okay, first figured out this and that to compute that. But in stable stage, okay, it's the other way around. Because you want to set the growth rate low enough not to be not to be bigger than world GDP growth rate. Okay, so you set the G first, and then you assume a certain ROC. Okay, a certain ROC which converges to WACC. I told you before, in a stable stage, ROC should converge to WACC. So put it as the same as WACC. And then the thing is, G divided by ROC should be your reinvestment rate. So at stable stage, reinvestment rate is something you solve for, okay, using these two information. Okay, that is different from your fast growth stage. You see the distinction? See this? All right, contrast. So that's basically what you see over here. Okay, reinvestment rate should be G over ROC, and this ROC should be close to WACC, right? That's what I'm saying. Okay. Now, our growth assumption for Netflix. So all in all, what do? Well, we have three different stages: initial 5 years, and then the next 5 years, and then stable stage. Fast growth, and then slowing growth, and then stable growth. Okay, different colors I use. Okay, now year 1 through 5, 6 to 10, and 11 on. So here in the fast growth stage, what do? Here, initial 5 years, simply 단순 무식, like I imposed 50% growth rate and then reinvestment rate of 58% over there. I did not impose any assumptions about ROC over here, okay? Because this is crazily going high growth in the market, okay? Not crazily, but really, really fast growing anyway, okay? So let's put it over here, and then I just fix the reinvestment rate like this, okay? The most important thing is I just imposed this 50% growth rate without looking at too much about this reinvestment or ROC, okay? And then if you are not happy with this, maybe you can play with this ROC and the reinvestment and try to be more scientific about how these two guys interact, so that you end up with 50% rate later on. But I'm just, this stage, Important thing is this guy, and then 50% all the way 5 years, right? And then the next 5 years, right? Yeah, we use economic fundamentals over here. ROC, and then reinvestment rate of 58%, just like before, and historical average until now, right? Multiply these two, 8.83% of growth rate, okay, for EBIT, right? So that's it. And then the stable stage, what we do? Well, we first impose the growth rate, 2.5%, world's GDP growth rate I told you before, and then ROC to be the same as WACC that we calculated before, because your competitive advantage will be eroded, okay? And then reinvestment rate is something we compute based on these two figures. Here, 52%, okay, which is lower than 58% over here, okay, which makes sense. High growth stage, you need high reinvestment. Low growth stage, you need low reinvestment. Or that means the same flip side of the same coin means high growth stage, your free cash flow will be small amount. Slow growth stage, stable growth stage, your free cash flow will be very big, okay, because of this reinvestment amount relation. So if you do this Excel spreadsheet model, here we have 2019, 20, all the way down to 30, right? And then we have 5 years and 5 years, okay? And we are standing in timeline somewhere over here, but we assume, I just use it annual data, and our year 0, okay? Time point 0 is, you know, January 1st of 2020. Let's assume it to be the January 1st. I know this is May. There's a 5 months difference, but let's just ignore it, okay? The 5 months difference, for our pedagogical purpose, it's minimal difference anyway, okay? Of course, there happened a lot of different things, COVID-19, blah, 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 but time period, okay? It's not that much important, discounting. So last year's NOPAT is this amount, and then it grows at 50% rate for 5 years. And then afterwards, starting from year 6, it grows at 8% level all the way down to 10th year. And then you get 10th year's NOPAT. Then to 11th year NOPAT growth rate, that's, where is it? This one, 2.5%, a 2.5% growth over there. Okay, so make sure you go one more year, okay? One more year, and then do what? Here, reinvestment is computed based on this reinvestment rate of 58% from year 1 to year 10, okay? Year 1 to 10, and then you compute the free cash flow to firm, which is subtracting your reinvestment from NOPAT, okay? So one by one, you can do that. Now, FCFF is there. FCFF is there. And then we are not finished yet. At the end of year 10, this is the tricky part. This is a tricky part. We have to compute something called the terminal value. Okay? Terminal value should be based on the free cash flow to firm in year 11. And then we are going to divide this guy by WACC minus G, which is 2.5% and 4.5% or something. Yeah, 4.82%, right? 4.82% and then 2.5%, right? Now, the question becomes, how did you compute this FCFF 11? Okay, FCFF 11. Here, people get awfully confused. Don't just grow FCFF at 2.5%. Okay? Don't just grow this guy by 2.5%. Why? Remember, at the stable stage, your reinvestment will be much smaller, and then your free cash flow will be much bigger than those you computed in previous fast growth stage, right? So first you make sure you grow the NOPAT first at 2.5%. That's this guy, right? Then compute the reinvestment with the new reinvestment rate. Not 58%, but 52%, right? And then subtract this guy from your NOPAT and you'll get to this one, right? FCFF 11. Now, once you add FCFF 11, you're ready to get the terminal value, WACC minus G, right? That's this guy. And what do? You compute FCFF one more time. I labeled it as FCFF prime, okay? Why? Because I want to include this guy in our FCFF 10 calculation over here. The rest of the FCFF are the same, okay? But this is how we do it. So once you got the FCFF year by year, what do? Get the present value of it. Okay, so enterprise value should be the present value of all FCFF primes, right? Here, the function becomes like Excel function of NPV, and then the discount rate, which is WACC, and cash flows 1 through cash flows 10. Okay, so that's how we compute using Excel function of NPV. If you refresh your memory about NPV in financial management, you will realize, oh, there must be something wrong with Excel's NPV function. Where is cash flow 0? You are right. Excel, right? Those engineers devising Excel, right, software are geniuses, but they did not learn about finance when they first established this function. Okay, error. They forgot about cash flow 0. But here we don't care about it. Okay, we don't care about it because there's no initial investment that we have to worry about, right? And then what we care about is a cash flow from at year 1, year 2, going into the future like that. So NPV function perfectly serves our purpose. Now, what you calculate from this is enterprise value, $296 billion. And then don't forget to add what? Cash, because you set the cash into your bank account. That's just sleeping, not doing any business for you. So add cash, then you will get to the firm value, which is market value of asset, right? Firm value, $301 billion. Now, don't stop there because your final destination is market value of equity. For that purpose, you need to what? Subtract market value of debt. But here in our pedagogical purpose, we assumed the book value of debt is equal to market value of debt. So subtract $16.4 billion, you get market value of equity, which is $285 billion. Now it's time to divide this guy by the number of shares outstanding. 438.8 million shares outstanding. So the value per share would be $648.97 per share. Wow! Compared to current share price of $438 per share, this is 48% upward potential. Holy cow, right? So if these assumptions, our assumptions are correct, okay? If our assumptions that I established over here are correct, then we would write a buy recommendation like this, right? Buy recommendation. Whoa, okay. But as you've gone through together with me, you saw a lot of holes over there, okay? So the most important message is don't believe the hype. Don't believe analyst numbers per se, right? What was their assumptions, right? We have to be careful. And then before we move on further, if you're wondering the EBIT growth pattern, right? EBIT growth projection, it looks like this. I just drew a graph for you, okay? based on our assumption over the next 5 years, 50% growth rate, fast growth, right, in EBIT, right, should be like this, 50% increase. And then 8.83% growth rate every year, okay? It looks like this. And then stable growth rate of 2.5%. So that's what it looks like. And you may wonder, this is too linear, then this is exponential. All of a sudden, this seems like a break. I don't like it. You may say like that. Okay, fine. Okay. You can adjust the moving growth rate over the second stage after year 5. Okay. Instead of saying a flat rate of 8.83% growth, right? All of a sudden, from 50 to 8.83, boom. Instead of that, you can assume some kind of declining growth rate. In the year number 6, there may be some slower growth rate than 50%, and then the 7, 8, 9, the growth rate will be tapering off, converging to 8.83% at year number 10, right? You can impose these kind of things, right? But how do we do that? Well, starting from year 5, right, 50% growth rate, and then your ending growth rate of 8.83%, right? Percent, right? If you compute the difference of it, you will get about 42% difference, and divide this guy by 5 years. Okay? Then you will get the annual declining rate, okay, of the growth rate. Say, directly calculate 50 minus 8.83 should be 41.17. Now we divide it by 5, 8.23%. Okay? 8.23%. This means that starting from 50%, next year, subtract 8.23%. Then you will get 41.77%. Make sense? The next year, what do you do? Again, you subtract 8.23%. Then you will get 33.53%. Again, and then again, and then again. Eventually, you will reach 8.83%, your final destination, right? And so it is a tapering off. We call it tapering off, right? Growth rate in the second stage, right? It's a bit complicated, but just please bear with me. This is the idea, all right? So year by year, you impose different growth rate, slowing down. The next 11th year, don't touch anything, right? 2.5% growth rate, it's just there, right? Don't touch anything. So that's your alternative way of doing it, okay? Then what happens? Well, remember, you are still assuming, in this case, you are assuming high growth rate, reasonably high growth rate compared to your previous scenario, right? So your valuation number will be bigger or smaller? Bigger, right? So that's what you're going to see. As you see it, free cash flow to firm is a lot bigger than before, and your terminal value way bigger, 2 times bigger. Now, let's see it. The next, if you follow, right, your ending number, right, value per share will be $1,271 per share. Wow! Which is about 200% up, right? Compared to today's price, right? So strong buy, you may say it. Some of you may say, crazy, that doesn't make sense. You're right. So for that part, you will have to adjust some other assumptions to tweak around, okay? and then which makes see if which one makes more sense, right? But this is how we do it. Okay, now if we move down and then do a graph one more time, EBIT growth projection using the second scenario, right? It will look like this, S-shaped curve like this. Okay, but does this look more appealing to you, the shape of it? Okay, compared to the previous scenario, right? So that's your judgment call, right? That's your judgment call. But this is how we do it. To be strict, you could use bottom-up beta by identifying the industry competitors. Also, you could do some sensitivity study by changing some of the variables, such as debt to equity ratio. If you want to, if you want to impose some kind of capital restructuring scenario, okay, so that the CEO all of a sudden changes the capital structure and borrowing a lot more, okay, what happens to the firm value and the share value? You can do it. Debt to equity ratio adjusted, beta will be affected, your cost of equity affected, WACC affected, and value gets affected. And then your reinvestment rate, okay, you'll have to think about it, but let's see. Also, you can do some kind of sensitivity analysis by tweaking around some variables that is not under your control. Okay, sensitivity, well, not under your control. Okay, this one I should have said more like a scenario. If there's a capital restructuring scenario, right, you can do it like that, you adjusting your debt to equity ratio. But more importantly, sensitivity analysis should be about some exogenous variable. Exogenous what? The variable comes out of the blue, right? For example, macro variable that you cannot control, the CEO cannot control, right? CEO cannot choose. For example, what could it be? COVID-19, when it goes away. So the fast growth stage will shrink down or it gets affected, maybe, okay? And then what could it be? Risk-free rate, okay, risk-free rate, what if the central bank changes it, okay? So that you will have it another way, right? Those kind of things you can tweak around and then see how the stock value changes together as you change this exogenous variable. Okay, RF kind of things, or RM minus RF. These, right, are not controlled by the CEO, right? Central bank or the investors as a whole over here. Risk premium is about the risk aversion, right? So what if the investors get spooked more versus they're going into the bubble, right? So that's something you have to do some sensitivity analysis using it, okay? That's it. Industry competitors, you can use what, investing.com. You see industry category, if you click it, and you will see a list of companies. Too many of them actually. You have to choose, right? Equivalent size of it, I guess, and then the business nature you have to determine, and then you can download those guys, the list in Excel format. Here I show you once I downloaded it, and I just select 11111 for some competitors, and you do the bottom up beta things based on this, right? So that's something you could do. And then CEOs, I mean, investing.com, they give you a list of managers so you can have some better idea about their management team and then their track record and things like that. Anyway, so that's about it for this class note. Thanks for watching. And then if you have any questions, please email me to the following email address. Thank you. Bye bye. 再见. Au revoir.